Hi everyone, today we will be overviewing Dance Classes financial model. If you find these overviews valuable, please like, share and subscribe to our YouTube channel. First of all, we need to create the rule saying that all our inputs will be colored with specific color. So we are going to use blue color with white font for all our inputs. That will ease the scenario building, stress testing for us, for all the third parties who will be using this model, for bankers, everybody. So these are the inputs, these are the inputs, these are the inputs, and so on. So first of all, we are setting up the first year of financial projections of our financial model. So 2020 will be the start of the investment stage. Then we need to specify when we get the first revenues, month and year. Here it is. This is also very important block of inputs because all the investment plan expenses, all the revenues, direct costs, fixed cost, salaries, they will all be linked to this moment inside the timeline. So you don't have to retype the investment plan, you don't have to retype revenues, expenses, and so on. So all of them will be linked to this this moment inside the timeline. If you want to displace and start the project in August, let's say, of 2020 or 2025, you can easily do that. All your investment plan expenses, revenues will be automatically displaced. Now we're moving to the next block of inputs, types of classes. So here we can specify the whole list of classes, type of classes that you're gonna use. So for example, rap or trance music or creep walk, whatever you wanna have in your dance classes. So then we need to specify the duration of one class. This parameter will be needed later when we'll be building the schedule for the typical week. Then we need to specify the price per lesson per person. This will be needed for the revenue generating algorithm. Then we are describing how many people we're going to have in one class. Then we are setting up the tutor's salary per one class. And then if we have one, we are specifying the percentage of bonuses from revenues that the tutor has out of each class, each lesson. Here it is. Then we have a status column, so we are able to definitely we must be able to switch on and off different types of classes from calculations and see how the project will behave with or without different types of classes. So if you are too optimistic with some classes, you will be able to switch them on and see how cash flow statement behaves without them, how simple discounted payback period look like with or without this or that types of classes, what will be the net present value. So here you will need these column many steps ahead. When financial model is ready, you need to do the stress testing, scenario building, scenario modeling. So you will easily be able to do that because here you can switch on and off different classes. You're looking at the cash flow statement, see how much financing is needed in this scenario, that scenario. So you're pretty flexible using this instrument during the stress testing actions or scenario building. So you can quickly create many scenarios and see how your project how stable your project, your business idea is. But this is very valuable environment when financial model is ready. Then, so we're moving forward. Now we need to describe the typical week of our dance classes. So we have the typical week from Monday to Sunday. We have also the holiday, and for each day of the typical week we need to specify how many hours we work per day. Now we're moving to the so next block of inputs will be the typical week. So we have the schedule for typical week for every day. Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday, plus holiday, and we need to specify what classes we're going to have each day inside the typical week. So for example, if we have this amount of classes in Monday, it says okay. But for example, if we want to add, so here we can add more classes, it says okay. If I want to add some more, I can add it, and here we can see that it is too much. We need to reduce the amount of classes on Monday. If we increase, for example, the amount of working hours by 12, for example, and now it says okay, we can add more. Let's copy, add some more classes here. Now it is too much, so we can reduce. So here we're building the typical week schedule from Monday to Friday. If you work weekends, the same for all the weekends. So this will be needed to build the realistic cash flow statement, the realistic revenues, the realistic payback, simple discounted payback period, because this will show you the cash flow that you will trust. Once you create the typical week schedule, you are absolutely sure that you got the realistic revenues. Once you get the realistic revenues, you will be able to see the realistic payback period. So that's why we need to create the weekly schedule to get the most detailed algorithm that will show you the realistic financing, revenues, payback period at the end of the model for all the scenarios that you will be building. So for every day we are creating the schedule. You will be shown whether it is realistic or not, or you need to remove some classes from the schedule. So you are just creating the schedule for your dance classes for each day inside the typical week. Then we are moving to the typical year. We need to calculate how many Mondays, Tuesdays, Wednesdays and holidays are living inside every month of a typical year. So this will increase the level of details of your financial model. This will be showing you the realistic revenues as a result. Then we also may have some seasonality in your business. So for example, in summer month you may have some decrease in attendance of your dance classes, so you can specify it here. So we have a typical year. If you have some fluctuations in attendance inside your classes, you may specify it here. Then we need to calculate the direct costs for the customers that will be attending our dance classes. So here we're specifying the cost of a new customer that will be joining the classes, and then we have the next block of inputs that is showing us that's describing how fast we're going to reach the target revenues. So why we need that? So we're assuming that we won't be able to get the target revenues, to reach the target revenues right from the first month of operating activity. So we will be reaching the target revenues step by step. So this is very valuable environment for the scenario building, because once you start playing with these numbers, you will be able to see the amount of operating losses inside the cash flow statement. Let me show you what I mean by that. So these percentages, so for example, if we start just from 3% of target revenues, if we go to the cash flow statement, we will be able to see these operating losses. So these operating losses you will have to add to the investment stage expenses to get the correct and accurate amount of financing. So once your financial model is ready, you will be playing, all entrepreneurs usually playing a lot with these percentages and see how operating losses affect their total amount of financing that they need to start. They're playing a lot with these percentages and see how much financing they need in optimistic scenario, pessimistic scenario. So maybe they are too optimistic, so sometimes they think that they need too much money, they need to wait to accumulate more financing to feel comfortable during the start. All these so sometimes they think they need to change a bit their business concept because they see that they need too much of financing. So all this is possible because they are playing with these percentages. Then the next block of inputs is dealing with how much percentages of customers are coming from the advertising, and these percentages affects the cost of each customer that comes from advertising is set up here. So here we are able to specify how many customers are coming from advertising, and this will be the cost of one customer that comes from advertising. So this forms the direct cost for the dance classes. Then we're moving to investment plan. So here the green column is the moment when we start the operating activity. So this is the column generated automatically. So we're setting up this column here on the top. Here it is. And then if we go back from that point to the past, this will be our investment plan. So here we specify what we are investing in, and here we specify how much we are investing in during the investment stage. Then we're moving to the payroll. We're specifying what positions are living inside our project. This is the salary per person on each position, and this is how many people we are placing on each position. Now we're moving to the fixed costs. So for example, rent, other office expenses. So here we're specifying what are the fixed cost items, and here we have the typical year, and we're placing the values for the fixed costs inside the typical year. So despite of them being so cold, you may have some seasonality inside fixed costs. Some of them may have some specific algorithms. So some fixed cost expenses will be paid once a month. Some of them may be paid once in 6 months, once in a quarter, once in a year, or some other algorithm may be applied to this cost. So here we have the typical year where you can allocate all these fixed costs, name them and place here. Then if some investment plan expenses have depreciation status, you can set them on and off and specify in months the depreciation term in months. Then we have the taxes. We have different types of taxes: value-added tax, asset tax, salary, net profit tax, revenue, and other taxes. So these are the rates, and these are tax based for each type of the tax that we can use in our financial model. So now we're moving to the cash flow statement. So cash flow statement, we can inside the cash flow statement we can press plus and see the detailed revenue for different types of dance classes. The same goes with payroll, fixed cost, direct cost, taxes, and so on. Here we can see how much equity we need, how much loan we are taking. So these are investment plan expenses, these are operating losses, this is the loan. Then we start, these are the payments for the loan: principal payments, interest payments. Here we can see that we are eating the cash flow. This is mathematical zero, and then the project starts generating its own cash, and this is how the cash grows inside the timeline. Then we can also specify the discount rate. These are main financials. simple discounted payback period in months, profitability index, net income, net present value, total financing needed that contains equity and loan, internal rate of return. So here we can add some loans, the amount of loan, when we get this loan, year and month, term of loan, interest rate, if we have any grace period, or principal, if we have some grace period for the interest payments or principal payments in months, we can specify it here. If we have several loans, we can specify some additional loans here, and they will be added here. Then we have the simple chart, simple discounted payback period, loan coverage ratio monthly, revenue and total costs, profit, profitability, cash balance at the end of the period, operational profit and debt payment. Then the same diagrams done yearly, revenue and total costs, profit, profitability, cash balance at the end of the period, operational profit and debt payments. Then loan coverage ratio. Here we have cash flow statement done yearly, P&L statement done yearly. This is the very simple table that will show you the total revenues, total cost, profit, profitability, cash balance at the end of the period, and so on. So just main numbers. And here we have the sensitivity analysis. So we have several yellow tabs for the sensitivity analysis. Once your model is ready, you will be able to see, so you can press this button, sensitivity analysis button, and you will be able to see how the project behaves if the revenues go up, down, if the payroll goes up and down, if fixed costs go up and down, if direct costs go up and down, if investment plan expenses go up and down, interest rate goes up and down, loan amount goes up and down. So you just go to the tab, press the sense button, and you will be able to see how financial efficiency numbers are dancing if this parameter increases or decreases. So you just you can select the step of changing. So at this point it is 15%. You can set up it to 10%. This will affect this line. Then you just press sense button, and you will be able to see what will happen to the project if the revenues increase or decrease to this extent. The same story with payroll, the same story with fixed costs, the same for direct costs, the same for investment plan expenses, the same for interest rate, and finally the same for the loan amount. So this was the dense classes financial model. If you find these overviews valuable, please like, share, and subscribe to our YouTube channel. We have several hundreds of financial models, so we'll be posting them on this channel, so I hope you will enjoy all of them. Thanks for watching. See you next tutorials and overviews. Bye.